You are listening to Keystone Stock Talk Podcast, episode 162.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We are back this week to look at the crazy volatility, mostly to the downside, in North American markets since the start of 2022. I take a brief look at the yo-yo action and a number of well-known tech stocks over the past week, including Microsoft, Alphabet, Apple, and Amazon, all on the plus side, and Netflix, Meta, PayPal, and the rest of the tech market generally on the negative side. From our mailbag, I answer a question on Cathie Wood's ARK Innovation ETF. Aaron reviews what went wrong this past week with Meta Platforms, owner of Facebook, the largest social media platform in the world. Meta dropped nearly 26% Thursday after the release of its fourth quarter results, a historic loss. Aaron lets you know why. Finally, Brennan answers a listener question on EcoSynthetic Inc., symbol ECO on the TSX, which offers a range of sustainable engineered biopolymers that allow customers to reduce their use of harmful materials such as formaldehyde and styrene-based chemicals. The stock has pulled back to start 2022, but has positive gains over the past year and 5-year periods. Brennan examines whether the fundamentals of the business justify these gains. So let's get into our show this week. I'm going to welcome both Brennan and Aaron. How are you guys doing?
Doing well. Welcome, gentlemen.
Doing well. Good afternoon.
Looking forward to a big conference we have coming up this week, the World Outlook Conference. Encourage any listeners out there, go grab tickets. Of course, to listen to myself and Aaron speak at that event. We'll be talking the small cap portfolio. Aaron's going to add some bonus dividend and U.S. growth stock picks in there. So it should be a good event. Really actually looking forward to when we can do this back in person again. It's virtual. So I love doing this event when there's 1,500 people in the crowd and, you get to interact with everybody there. We have hundreds of clients that go to this event every year. It's nice to sit down, shake their hands. Hopefully this time next year we get back in person. 2 years in a row we've done it virtually. It'd be good to do that and bring Brennan into town, right?
Yeah, I just want to get out
for dinner.
Out of Saskatchewan. Well, it's minus 30 out here, so it'd be nice.
That's the only thing I'm not looking forward to, actually. But I would agree with Ryan, though. I'm getting a little sick of these virtual presentations. It'd be nice to get back in front of a live crowd of people, actually go to some of these conferences in person and see some people that we haven't seen in a couple of years. It's been 2 years now since we've spoken in front of a live audience, and that's the longest I've ever gone without speaking in front of a live crowd in my since I started in finance.
It's
close
crazy.
to 2 decades ago. So definitely looking forward to that. And of course, looking forward to seeing Brendan too, I guess.
Aw, thanks.
Yeah, I mean, we're going to see him in a month. We get to go a month and a half. We get to go to knock on wood right now. We're scheduled to go to a conference in about 400 companies in California, do some research down there at the Roth conference. So that should be, getting back to more normal type of interactions that we have with the, companies that we put into our research. So that should be nice. Hopefully that is to kick off some normalcy going forward. Now, I talked about the volatility. I'm going to answer a question here first on PayPal. We got a number of questions from listeners. We also had clients in our chat ask about it. So I'm just going to answer the way I answered in our chat. I said PayPal, huge volatility to the downside. It's a business we like and monitor, but have not recommended due to valuation concerns over the past several years. I said it's the latest in a cautionary tale of valuations. The market appears to be reminding investors that valuations do indeed matter. The company PayPal reported decent growth in its quarter, but missed earnings slightly and guided to lower growth this coming year. Growth in terms of revenues to about 15% from analyst expectations of 18%. That doesn't sound that terrible, but there was some more disturbing, parts to the growth guidance are concerned. The company expects to add about 15 to 20 million new accounts in 2022. That's down from 48.9 million in 2021. So the growth is slowing there. And a year ago, PayPal set out plans to double its active accounts to around 750 million by 2025. So over a 5-year period. At its 2022 pace, it will come nowhere near to that goal, essentially. So having said this, in a normalized valuation period, this type of announcement is not likely to lead to a stock losing 25% of its value in one day, particularly such a large business, and a stock that had corrected nearly 45% already over the past 6 months. However, when a company with high or premium valuations that grows at, say, 15 to 18% stumbles slightly, it can get punished. So the company now, where is it now? That's what our clients are looking at. What do we do now? We don't own the stock, but they're looking, is it a time to buy? It's around 26 times forward estimates. Now, these estimates, in our opinion, will likely have to be lowered given the guidance going forward here. But it may be starting to look a little more interesting on a valuation basis. But again, to give you an idea, the average market PE is 22.5, so it's still a premium to that. It's not historically cheap, despite the stock in the last 6 months. PayPal, a venerable business, it's dropped 60% in the last 6 months. On a valuation basis, it may still not be on sale right now.
That's incredible.
You guys want
these
to
companies,
get in on that?
These
yeah,
companies.
it is.
And we're going to talk
not?
about Facebook a little bit later as well. It is incredible to see these almost in the case of Facebook, almost $1 trillion company lose a quarter of its value in a single day. You don't typically see that level of volatility in these kinds of names. So PayPal. No. I know it's one of the things that investors are worried about is that it's a very competitive business. From a valuation basis, I mean, it's cheaper now than it's been in a long time. But really what the market is saying is that they don't trust the growth going forward. And I think that's true in a lot of names. But should we talk about some of the research we're doing in this space, Ryan? Are we ready to do that?
Sure. I was just can I summarize
Certainly,
the week that was kind of for
do that
and
first,
then
we'll
can
talk
definitely
about,
do that. Yeah. I mean, it was a tale of two. Most of the attack was weak. Has been weak since the start of the year, and really weak since September. In my speech at the Outlook, I outlined how there's a stealth correction going on. The FANG stocks, which had been performing tremendously well and still are relatively, had been hiding and masking the gains because of their power and their weight in the overall index. The correction that's been going on in the index overall in terms of the US and the NASDAQ. But if you look this past week, those who beat estimates and had good growth estimates going forward were safe. Microsoft, revenues up 20%, net income 21%, widening operating margins. Demand remains strong, stock holds in or does well. Google, revenues up 35%, beat the top line estimates. They announced a 20-for-1 stock split. Both of those we have owned for our clients, recommended is what I would say. And they escaped the carnage. In fact, Google one day was up a couple $100, 8% in one day this past week. Apple, the single largest quarter for the company in terms of revenue ever, 11%. Sales were up 11% despite supply chain issues. So good quarter, stock does well. Amazon, net sales up 22%, besting estimates, earnings bested estimates significantly. And the stock, after losing, was up significantly this morning in trading. So, but those who get beaten up this past week missed estimates. In the past couple of weeks, including Netflix, they added 2.5 million users in Q1 versus just under 7 million. That was the estimate there. So there's increased competition in this space, in the streaming space. Increased prices amid slowing growth. They have increased prices, but the stock was killed. Facebook. Aaron's going to go over this more, but they missed earnings. Weak guidance, stagnating user growth. It lost over $200 billion in market value in a day. That is absolutely staggering. And PayPal, missed. Well, missed slightly, but the guidance going forward, the growth guidance was definitely a miss. And, the stock, like we said, it's corrected 60% in the last 6 months. So if you're hitting, you seem to be safe right now. If you're missing and trading at premium valuations, that is not where you want to be in the market right now. And investors are punishing those stocks to a degree that we haven't seen in a long, long time. And if you want to go in, Aaron, some of the research we are doing, because when there is volatility, we talked about this, what we see is opportunity, whether that happens today, tomorrow, 6 months from now, a year from now, we do see some opportunity. So we're doing some research into some of the big and the mid-sized tech level companies in the U.S. where we've seen some corrections. Hopefully we can start to buy some businesses that we may have wanted to own for the past 2 to 3 years, but have been just too expensive.
Certainly. And really, when I see this level of volatility, it actually makes me excited because one of the areas of the market that I find the most interesting and have for years is, of course, technology. And when you talk about innovation, problem-solving types of businesses that are really providing solutions to the problems that the world and society faces. Obviously, technology is right up at the top of the list, but valuations, we've made some select recommendations in the space, have performed very well. They performed very well over the last couple of years. But, by and large, the valuations in technology have just been, in some cases, obscene. And we've had to take companies that we love and reduce them from a buy to a hold just because we saw the valuations becoming, I would say, unjustifiable. Well, technology has been hit more than any other sector right now. And if you look at just the NASDAQ 100 index, I believe it's down about 10-12% from its highs just in November. But that doesn't even really tell the story. There was a report out in early January about how I think it was 40% of the companies in the NASDAQ. This is not weighted for market value, just the number of companies in NASDAQ were down. What was it, Ryan? Like 50%?
50%. Like cut in half. And it's accelerated into 2022. So when we get the numbers out right at the end of this month, going into February, I'm going to guess there's you got nearly 50% of the index probably down half or more, which is, a shocking drop that's been, like I said, it's a stealth correction that's been masked by strength in the FANG stocks. And then you also
and that's
saw
why there's less of a decline in the NASDAQ overall, because the FANG stocks, like companies like Alphabet, Google.
The NASDAQ 100, what is it, 50%?
Crazy. They make up a huge portion of the actual market value. So when you market value adjust it, they really reduce that loss. I haven't verified those. Those numbers seem unreal. I haven't verified them specifically, but they certainly coincide with what I've been seeing in that space through my research. So one of the things we've done over the last couple of weeks here, we've been researching a very specific list of U.S. technology stocks. It started with 150 profitable U.S. technology software companies. And we've now reduced that list down to about 35 companies through our research. So these are some of the most profitable, fastest growing, most innovative technology companies in the market, in the world today. And what we're doing is we're continuing to look through that list, and we're hoping to come out with at least a couple of recommendations out of it. And certainly if there's more volatility to the downside, valuations start to look a lot more attractive. But just to give you some stats, the average company in this list has been growing revenue at 35 to 40%, 30% cash flow margins. So very profitable businesses. These aren't companies that are producing revenue but not producing profitability or minimal profitability. These are high growth, highly profitable businesses, and on average from their highs 52-week highs, these stocks are down about 30%. So in many cases, these are businesses that are going to continue to perform or should continue to have strong growth drivers going forward. There's several of them that we know very well. Some of them are still relatively expensive, but valuations in some cases, when you look on a forward basis and continue the growth, have been cut in half. So a lot of names are starting to look more interesting to us now. And this could be a huge opportunity over the next couple of months to buy some great stocks at better prices.
So I'll take another listener question right now, and it kind of dovetails kind of into what Aaron was talking about. There's been a significant decline in some of these technology names. It's a fund. Somebody asked, is it time to start buying Cathie Wood's ARK Innovation ETF? So and I'll go over this question right now, and at the end, I'll say how this fund differs from, in terms of its constituents, what the assets, the stocks that it holds in the fund differ from what Aaron was talking about in terms of that research, in terms of those technology or software related companies, because we're looking for profitability, and that's not necessarily part of the equation in terms of their criteria here. So to begin with, what is the ARK Innovation ETF, symbol ARKK? It's an actively managed exchange-traded fund. It seeks long-term growth of capital by investing in, essentially, its theme is disruptive innovation. So areas of DNA technology, genomic revolution, automation, robotics, energy storage, our AI, next-generation internet, fintech, and a number of other things. Now, it's run by recent market darling Cathie Wood, which it owns. Other than Tesla, it does not own many of the mega caps. And the last time we checked, there's none of the FANG stocks in that fund or ETF. But there's these potential disruptors and innovative stocks. To be clear, the fund performed very well for 3 to 4 years as money piled into these type of stocks. But the ARK ETF has lost billions in its unit price is down 38% in the last 3 months alone, over 50% over the past year. Mirroring some of the losses we saw on the that stealth correction in the market. Again, I reiterate what I said in reference to PayPal. It really turns out here that valuations do matter, particularly when we look at uncertainty, including inflation, rising rates, and dwindling stimulus. So that's likely leading to part of the drop here. But I took a look at the valuations on the top holdings in the fund right now, and that's how we judge whether or not we would want to buy this fund. Again, this is after many of these companies have dropped 50% in value. So are they attractive now? Are the constituents of this fund attractive? So we look at the top holdings. Tesla is the top holding in this fund. There's Teladoc, Zoom, Roku, Coinbase, Exact Sciences, Unity Software, Spotify, Intelia, Unipath, Twilio, Shopify. Many are good companies, but are they trading at reasonable valuations even after the drops? Now, we're going to take the giant Tesla out of the equation here. All the valuations in the company are certainly still elevated. So to give you a context, like I said, the average market P is 22.5. Only one of the companies that I just mentioned there have a PE of under 30 right now. That's Coinbase, and its earnings are actually expected to decline in the coming year. 7 out of the 12 stocks that I mentioned, the top holdings in this fund, do not have any current earnings or even adjusted earnings. And while their price to sales multiples have decreased because of the significant drop in the share prices, historically they remain high. So again, most of these stocks lost 50% of their value or more. So one can only imagine the valuations on this fund if we look 3 to 6 months ago. Many traded at 50 to 100 times on a price to sales basis, particularly the SaaS-based businesses here. To give you an idea of how overvalued these businesses were, here's a quick breakdown of the peak valuations of some of the true disruptive best companies over the past decade. So if you look at Alphabet, what was its highest? Google. What was its highest price to sales in its history? 23. Netflix, 14. Salesforce, which CRM leader, 19. Amazon was 40. But this was Amazon in the .com boom. 2 years later, it traded at 1x sales. So it was just an absolute blip on the radar. Meta or Facebook at 24. So as you can see, this is a list of true once-in-a-lifetime investments. Not even one of these companies came close to a price to sales of 45. So you see many of these companies trading at 50 to 150 times sales at their peaks, really trading at premium, not premium, but mind-blowing valuations, to be honest. Perhaps ARK will achieve some long-term wins with the other Teslas if it can come up with that will boost the fund. And we love innovation. Aaron talks about this all the time. And we will pay up for great businesses, but we prefer paying a reasonable price or a little more for a great business rather than just any price. As such, we would pass on the ARK flagship ETF. It just does not meet our criteria. At least the primary assets in the fund do not meet our criteria. And we're going to prefer to look at the innovative tech-based businesses that are actually making money right now, some babies that get thrown out with the bathwater. If this correction continues, maybe we buy some of those. Likely not the companies that have really good revenue growth, but zero profitability. Those will leave for others to purchase.
That was a great segment.
And we've always said, profitability is about the validation of the business model and whether or not, whether or not that company is able to actually, one, generate revenues, but two, actually drive some of those dollars to the bottom line. Like, that's a validation of the business model. And that's the reason why profitability is a minimum criteria for our research. There are businesses out there that are not generating a profit that will one day generate a profit, certainly, but it's very difficult. It's very difficult for individuals to determine, which of those businesses are going to one day become real profit, cash flow generating companies. And if there's one thing that you can do that helps you to avoid a huge amount of risk, unnecessary risk in the market, it's to just focus on profitable businesses as investments, at least for the very core, for the core of your portfolio, for the vast majority of your portfolio. That reduces a huge amount of the risk with investing. And there are plenty of great businesses out there that are generating a profit and can produce extraordinary returns and extraordinary growth. So no need to take unnecessary risk when investing.
Yeah, it's just a core to our philosophy, and just taking that undue risk with your hard-earned dollars is just not necessary. There's a ton of volatility you can have even in profitable businesses, but a company that has not proved its ability to create cash flow. People will reference Amazon all the time because it ran at losses or for years, but Amazon's an absolute unicorn. To put that as a benchmark for every other unprofitable high growth company at present is, in my opinion, frankly ridiculous, because that's your outlier. You don't use that as a benchmark for what your investment philosophy is going forward. And we've seen many in the markets doing this for a couple of years. For me, it's undue risk that you don't have to take. Even when Aaron was talking about the list of companies we're talking about, he said there was 30% decline in those on average, where, you look at this fund who is investing in this ETF, it's investing in these. There's some really great businesses that we like in there, but they're paying just any price for them at some point. And, it has had a 50% on average decline over that period. You would expect them to be significantly more volatile than the businesses that are actually creating cash flow. And just by those raw numbers that we put out there, you can see, a 30% decline versus a 50% decline. The profitability does matter and valuations will matter. And it looks like right now in the markets, investors are getting back to valuations mattering, and you need to know what is in your portfolio and the valuations on those businesses right now, whether you want to continue to hold them or sell them or buy more. So let's look at Meta Platforms, Facebook, essentially.
From our Stars and Dogs segment, it's time for this week's Dog.
Aaron's going to look at the activity on this company over the past week. A profitable business, but there was a miss here and some growth outlook that looks a little bit negative going forward. And Aaron's going to examine that now.
Certainly a highly profitable business and one of the largest companies in the world. So this is not what I would have normally considered a speculative name and something that you would expect to lose so much value overnight. But let's get into it here. So Meta Platforms, formerly Facebook, is trading now today at about $230 per share. It's a $660 billion market cap company, but only a couple of days ago, it was almost at $1 trillion. So Meta Platforms, of course, is the owner of the Facebook app, which is the largest social media platform in the world, about 2.9 billion monthly active users. Meta also owns Instagram, Messenger, and WhatsApp. This is essentially it's an advertising company with 90% of the company's revenues coming from advertising. So Meta's stock price took a huge plunge this week, declining 25% on Thursday after the release of its fourth quarter results. That's a loss of market value of over $220 billion in a single day. Rarely do you ever see a company of Meta's size take this kind of a plunge in a single day. Of course, there are not many companies that are Meta's size. So what happened? Well, the short answer is that Meta missed analysts' earnings estimates and also reported weaker than expected guidance. The company reported Q4 earnings per share of $3.67 on revenue of $33.67 billion, compared to consensus estimates of $3.83 in earnings per share and $33.44 billion in revenue. So Meta's revenue actually came in slightly above estimates, and earnings per share fell short of estimates by only about 4%. Hardly seems like it justifies a 25% drop in a single day. But Meta also released guidance for year-over-year revenue growth of 3% to 11% for the first quarter of 2022. This would be a significant drop in revenue growth relative to previous years. Over the last 3 years, the company has averaged revenue growth of almost 30% annually. So this is a big drop. But still, Meta was trading at 24 times earnings before its earnings were released and before the big plunge. So it's not like it was being priced at the level of a company whereby the market would have been expecting consistent 20 to 30% revenue growth for the foreseeable future. The market was already pricing in lower revenue growth beforehand. So what's really going on here? In our view, the big move down is largely about competition. We actually had Facebook as a dog of the week last year as well. And one of the things that we pointed out is that in spite of the company being highly profitable, having good growth, it was really under a lot of competitive pressure from social media platforms like TikTok and Snapchat. These are the types of platforms that are much more popular with younger viewers. Now, I am not in any way an expert on what is cool with the younger generation these days. I'm sure there's all sorts of social media platforms which are cooler with the Generation Zs that I don't even know the names of yet. But I do know that Facebook has really lost its cool factor amongst the younger generation. So it still has Instagram, but Facebook is the larger part of the business. And there's just some concerns that investors have, rightfully so, about what the social media platform looks like over the next 5 years or more. Also, Facebook always seems to be in the crosshairs of negative press these days. The discussions about the dissemination of fake news and disinformation, the company is often held largely responsible for the polarization we're seeing in society right now, politically and socially. And it's been accused many times of willingly knowing that it's allowing its platform to be used for nefarious activities and the distribution of misinformation purely so that it can make a profit. Now, I'm not here to discuss the social ramifications of Facebook or social media in general, but between the increased competition in the market today, Facebook having lost its cool factor among younger users, and then the constant stream of negative press, it becomes not difficult to understand why many investors are quick to hit the sell button when they see any type of kink in the company's armor. What's our take on all of this? Well, ultimately, I view the single day drop of 25% in Meta's share price likely as an overreaction. The company's trading right now at about 17 times earnings today. This is now a significant discount to the overall market. It's a very significant discount to the FANG group, or the group of what are considered the 5 largest technology companies, which would be Meta, Amazon, Apple, Microsoft, and Alphabet, which owns Google. Now, growth will certainly decline. It may even go negative for a while, but we don't see any clear signs necessarily that this company is falling apart anytime soon. The company's investments and journey into what it refers to as the metaverse could eventually be the beginning of a new leg of growth for Meta. Right now, that is really just speculation, though. It's just really too early to tell. So this said, however, we're not in any way ready to hit the buy button on the company at this point. There is a lot of uncertainty still in Meta's future, and we already have standing recommendations in our research on 2 other major technology stocks. These companies have been more predictable. Their businesses are more predictable. They have far better growth outlooks in the near term, and they've also produced much better performance over the last couple of years. So while Facebook is something that's interesting at this price, it's not something that I'm necessarily going myself and rushing out to buy, as I see from a risk value growth perspective, some other opportunities in the space that are more interesting.
Excellent. I think the most shocking part of that analysis is that you state you are not hip to what kids think is cool.
I think I am
floored
the
me.
exact opposite of hip to what kids.
Oh, what? You're hip to me.
Me too.
So.
Me too.
That's all
well, that
matters,
doesn't say much
right?
about you guys, but
That
especially
says
you, Brendan. You're a
limited,
young
so,
man.
yeah.
You should be much more in tune with what's cool.
Well,
Didn't he say he thinks you're
I
hip,
do think you're
which
hip, yeah,
basically
but,
reflects on how hip
I
he
will
is.
say that
so.
I never downloaded TikTok, and that is where the kids are looking these days. And I think even Mark Zuckerberg even said that in their earnings call. I believe that was taking a big hit.
Who? Who?
Mark Zuckerberg.
I have teenage nieces, and they're all about TikTok. They're all about Snapchat. They no interest in Facebook. Instagram, I think, is still cool for now, but TikTok, Snapchat, that's what I'm hearing a lot about. But
yeah,
I mean, I think there's.
I have a 16-year-old, so yeah, I can confirm.
And I think that
I can, and Discord and things like that. People don't even. A lot of people don't even know exist.
Not even on.
But
exactly.
It's
something else,
and half them they're trying to.
Something
hide
else that I'd like to add
too
is and Ryan brought this up actually just the other day. Is I believe that Facebook was kind of alluding to the fact that the new iPhone operating system was also.
Oh, it's changes in Apple's iOS system,
exactly.
Right? Privacy changes raised concerns. Facebook's not. I mean, the concern is not able to track and target users as well. So that is a big concern. It hasn't affected Alphabet as a company. Essentially, they're saying it hasn't affected them as much. I mean, there is some privacy issues that would likely affect Alphabet as well. But I mean, because they have so much data, because they own that search engine that people go to, it's called Google. They've aggregated a lot of data, still able to target quite well without as much of the privacy concerns that many people have had with Facebook with the tracking. That is one of the concerns going forward, and you have that fear out there, and it's shocking amount of market cap lost, and in such a short period for a company of that size. Sure. A lot of investment going into the metaverse for an uncertain return, and you're seeing the stock get priced because of those risks right now. There's certainly other names that we would prefer, even though there's a significant loss there. Although, Facebook has done tremendously well over the long term. I'm not shorting the stock, is what I'm saying right now. Certainly not doing anything like that.
I would say Facebook, and this isn't necessarily something that enters too much into the investment equation, but Facebook is a company that people just love to hate. I would say more than just about any other company I can think of. So.
Yeah, going back to the reference to the kids, quote unquote, as Facebook versus Alphabet, or they love YouTube. Like they still the 16-year-old, they're still just all over YouTube, right? So
I guess I'm more hip than Alphabet, I thought, because I love YouTube as well as an educational resource. I think it's fantastic.
Yeah.
Maybe I am cooler than I
so
thought.
It hasn't lost its cool factor or whatever you want to call it. It's just very useful. Like I don't even know if it has to be cool.
Very useful.
You know what I mean?
learned how to work on my car because of YouTube. Following tutorials. It's very very useful. Yeah.
I Yeah, I told my mom the other day, she was like, just looking at some recipe for something, I'm saying, Google this, get it on, and she's like 79, turning 80, boom, she's like, uses it to get a recipe right? And she's, I think the only time she hasn't got a recipe right in her life, but she used that, and she's like, this is really good. I'm like, well, it is, yeah, it's great. Anyways, as we gush over Alphabet, we want to get to our final Your Stock, Our Take.
It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Brennan's got that. It's on, what's the company? Ecosynthetic?
Yeah.
Is that what it is?
Ecosynthetic.
Yeah, ECO on the TSX. Ecosynthetics.
Yes.
There we go. Something
Thank you.
that. On ECO on the TSX, interesting company, but you're going to look at whether the gains that we've seen over the past year and even 5 years in the stock are really driven by and are supported by the underlying fundamentals, or is this been like a feel-good environmental trade that really that isn't justified by the underlying numbers? I think that's what you're going to look at now.
Okay, so this Your Stock, Our Take came in from Gord via email.
Thanks, Gord.
Again, I'm just going to... yes, thank you, Gord. I'm just going to repeat it again just because I was talking over Ryan there. Ecosynthetics Inc., ECO on the TSX, currently trading at a price of $5.11 and has a market cap of about $303 million. So the company Ecosynthetics is a renewable chemicals company specializing in bio-based materials from natural feedstocks such as potatoes, tapioca, and cornstarch as an alternative to petroleum-derived feedstocks such as formaldehyde and styrene-based chemicals. So the company's two flagship products are Exosphere Biolatex, which is used in paper and paperboard packaging industries, where essentially it allows colorful graphics to stick to glossy paper. And their other flagship product is DuraBind biopolymers, which are a no-added formaldehyde binder system used in the production of wood composite panels. So a few key points on the business here is the company's strategy is to diversify a little bit away from their paper and paperboard market. That is their primary market, and they want to focus more on their wood composites as well as personal care markets. I looked into the segments and I couldn't actually find out how much is coming from each of these segments here or each of these markets. So now I'm going to take a look at the history here, and you guys will understand why a bit. But the company had its initial public offering in 2011, where it raised over $100 million at $9 per share. And it appears that since then, the company has really just been milking this cash balance over the past decade, where in 2012, they had about $93 million in cash. 2015, they had $61 million. In 2018, they had about $45 million. And the last quarter, they had about $41 million in cash. So this is definitely how the company is staying afloat. You guys will see that as once I get into the financials here. And as well, I find that it's interesting that that this company is buying back its own shares, even though it's not yet profitable, where during the first 3 quarters of 2021, the company canceled about 200,000 common shares for just under $1 million, essentially. So I think that is interesting. They're doing that, even though they're not profitable yet. So let's look at this lack of profitability and the revenue growth. So the recent financial results for Q3 of 2021, revenue was up 57% to $4.7 million compared to the same quarter last year. Now, growth was from higher sales volume along with higher average selling prices. The company is still losing money, as I have said. They lost about $800,000 compared to a loss of $600,000 for Q3 of 2020. They're also losing money on an adjusted EBITDA basis, losing about $116,000 compared to about $230,000 for Q3 of 2020. And like I said, they've got about $41 million in cash with no debt. And looking at the valuation, the company trades with a trailing price to sales multiple of about 18 times sales. And even if we estimate that the company can get back up to its high watermark of $23 million in fiscal 2021, the company still trades at about 13 times sales. So very pricey. And looking longer term, The company has really struggled to grow revenue and has never really broken into profitability, where in 2013, we saw the company post revenues of about 22 million. Then they declined to 13.3 million in 2016. Then they came back up to about 18.4 million in 2019. And in 2021, it does look like they're back on track to breach that 20 million. But really, we just haven't seen much growth over the long term, which is definitely a concern. So our take here, with EcoSynthetix, I believe the lack of consistent growth and profitability over the past decade is really the primary concern for me. It looks like a decent company in the fact that they are playing on the theme of sustainability and have a healthy balance sheet with the goal of diversifying out of its primary market of paper and paperboard clients. But with the spotty history and the business trading at 18 times trailing sales, it's just way too pricey for us, which would, of course, keep us on the sidelines.
Yeah, I mean, it seems like an interesting business, but, we look back, you detailed it, 2012, first year, I believe, public company, or in that range, 19.6 million, 2013 got up to 22.2, hit a low over that 10-year period of about 13.7 last year, and is rebounding this year, but up to, trailing 12 months, 16.6. Maybe gets to 20 million this year. Well, in 2013, it did 22.2 million. Operating losses each year, they are reducing, but there's no growth here. So you're pulling back on costs or inputs. It looks like, a good type of business. I like what they're trying to do, but it doesn't look like there's any growth in the end market. So I'm not sure how their stock has gone on a move higher over the past 3-5 years, other than being in an area where people want to invest, which is good. It's good, but they, you're not making any money, and all the original investors that invested in this company, really, there hasn't been any cash flow. And it is strange to me at the current valuations to be buying back any shares and not have any better use of those funds.
And what happens when that 40 million
believing in the story rather than the fundamentals?
Exactly. And what I was just going to say is, what happens when all of a sudden that 40 million in cash that they've been slowly milking does dry up?
And it is one of their saving graces. They got that 40 million. The operating losses aren't huge. So, you got years and years to be able to continue to operate, and perhaps they, enter into new markets. But, right now, 10 years, there's been zero growth in the business. So you'd think if they had the greatest solution out there, somebody would be beating down their door, or they could have got it in front of enough people or enough other businesses to grow sales at a consistent rate, or grow them at all over the past 10 years. We're just looking for business that have some growth, and it hasn't been there. All right. I believe that'll end off our show for this week. I'd like to thank all our listeners for sending their questions in to our Your Stock, Our Take. Ask us anything as well with the Cathie Woods ARK ETF question. Keep those questions coming in. Keep reviewing and rating us on iTunes. Give us a 5-star rating. We'd love to see that on there. It keeps us pumping out the content. And again, I'd like to wish everybody out there profitable investing.
Thank you all. Profitable investing.
Thanks, everyone.